Hello, in this video we're going to be taking a look at flexible budgets and standard cost systems, which is chapter 8 in your book. So let's look at our learning objectives. We're going to look at 3 of them. When you're finished studying this chapter, you'll be able to prepare flexible budgets and performance reports using both static and flexible budgets. We're going to identify the benefits of a standard cost system and understand how standards are set. And then finally, we're going to compute standard cost variances for materials and direct labor. And once you do the materials and labor, you should have enough information and you should understand it well enough that you'll be able to also do overhead variances. So let's take a look at what we're going to be talking about here. Flexible budgets and performance reports. So remember that in the last chapter we prepared budgets. So the budgets are an estimate of what's going to happen in the future. Well, a performance report says, how did we really do? Let's compare the real results, actual results, to what we thought was going to happen. And the difference between these actual results and the standard or the budgeted amounts are called variances. So a favorable variance is when actual revenue is greater than budgeted revenue or actual expense is less than budgeted expense. Remember that a favorable variance means operating income was higher than budgeted. Let's think about this for a second for yourself. Think of your own personal life. Imagine that you expected in a particular month to bring in $1,000 for whatever. You expected to get $1,000, earn $1,000, whatever. But when you get to the end of the month, you actually earned $1,300. Oh, okay. I thought I was going to get $1,000, but I actually got $1,300. That's good. That is a favorable variance because you got more revenue than you thought you were going to get, right? Now, think about your expenses. Let's think about a favorable expense. Let's say you budget your electric bill to be $150. But you open up your electric bill and you actually only have to pay $125. Oh, that's good, right? So favorable variance works like that, and unfavorable variance is the opposite. That's when actual revenue is less than we expected it to be, so that's not a good thing, or our expenses are greater than what we expected them to be. So a static budget is the budget that we prepared earlier. A static budget is a budget for one level of sales. So remember in the last chapter, the first thing we did was we made a sales budget, and that was our level of sales that we budgeted. A flexible budget, on the other hand, is a budget for multiple levels of sales. So what the company management is saying, well, what happens if we sell this many? What will our income look like? What will our expenses look like? All right. So here is an example of a static budget performance report. Now, let's take a look at this. What do you have here? You have actual results, so that's what actually happened for the period. You have static budget amounts, and then you have a static budget variance. Now, notice that they predicted they were going to have sales of 50,000, but they actually had sales of 52,000 units. Those are units, right? So they had a favorable variance. They sold 2,000 more than they thought they were going to sell. Now let's look at the sales revenue. So what happened? They estimated on their static budget that they were going to have sales of 375,000, but they actually had sales of 384,800. Now, why? Of course, you might be thinking to yourself, sure, they sold more units, right? So their sales should be higher. Well, we're going to look at the details of that later. That's one of the things that we'll look at. But what happens? You have a $9,800 favorable variance. Why? Our revenues were greater than we budgeted. Okay? Now, let's look at direct materials. Direct materials are a cost, right? We thought we budgeted $87,500. Our actual direct materials were $104,000. We have a $16,500, which is a fairly significant variance, right, compared to this. We have a $16,500 unfavorable variance because our cost is greater than what we budgeted. But direct labor is a favorable variance. So direct labor, we budgeted $150,000 and we actually only incurred $145,600. So that is a favorable variance. Now, It's possible that your materials are greater for two reasons, because maybe because part of it is because you produce more units, but also maybe you bought higher quality materials. And maybe because you bought higher quality materials, your laborers didn't have to work as hard. Maybe it was easier to work with those materials because they were better quality. So there is a lot of interrelationships between the different kinds of variances, materials and labor. All right. Okay, so now let's look at a flexible budget. This is a flexible budget, and as promised, it's at different levels of activity. So there's 3 different sales levels here. This shows what happens, what the budget is if you sell 48,000 units. This one shows 50,000. This one shows 52,000. So where do these sales revenue numbers come from? Well, you take the per unit amount and you multiply it by the number of units, and that works for all of these also, by the way. So we have 750 times the 48,000 gives you 360,000. 750 times 50,000 gives us the 375, and 750 times the 52,000 gives us the $390,000. So the same with all of these, you multiply each of these by the different numbers of units and you're going to get the budgeted amounts. Notice down at the bottom, remember our friends' fixed costs. These are all variable costs. Remember our friends' fixed costs. Down here, notice that at all levels, assuming we're within the relevant range, right? All of the levels, all of the fixed costs are the same at all the levels. They don't change, right? Let's take a quick peek here. 5% of sales. This one's a little different. It's not a per unit amount, but all this number is take 5% of the actual sales, the $360,000, and that gives us the $18,000. So that's what a flexible budget does. It shows the different levels of possible activity and what could be expected at those levels of activity. Now, we're going to be comparing different amounts. In this case, we're going to look at what is the difference between the actual results, so that's what actually happened in the period, the flexible budget, which is based on the actual number of units sold, and the static budget, which is based on the expected number of units sold. So in the example we just looked at, the static budget, remember, was based on 50,000 units, but we actually sold 52,000 units. So the static budget variance is the difference between the actual results and the static budget. That is broken up into 2 different variances down here. We have the sales volume variance, and that's the difference between the static budget and the flexible budget. And then we have the flexible budget variance, which is the difference between the flexible budget and the actual results. So this is what that looks like on a performance report. There's a lot of numbers here, right? So let's take a look. All right, so over here on the left, we have budgeted amounts per unit. These are the numbers we saw before, okay? So that's not too scary. Actual results always have to be given to you, all right? So if you're in an accounting class and you're working on an accounting problem, there's no way for you to compute actual results. Those have to be given to you. Remember, the difference between actual results and flexible budget is our flexible budget variance. Notice these 2 are the same, right? Because this flexible budget is based on actual quantity. So the actual quantity was 52,000. All right, so our actual results were 384,800 for our sales revenue. And our flexible budget was, flexible budget was 390,000. So we have an unfavorable variance because at 52,000 units, we should have sales of 390, but we only had sales of 384,800. Now let's look over here. Our static budget was 375,000 in sales, but we actually had 390,000 in sales. So this is a favorable variance. Now let's look at one of the costs. Let's look at direct labor. So direct labor, we'll start over here again. Our actual results are 145,600. Our flexible budget was 156,000. So we have a favorable variance because we budgeted 156,000 and we actually spent less than our budget. Over here, our static budget was 150 and our flexible budget is 156. So the difference due to sales volume is an unfavorable $6,000 variance because this 156 is greater than that 150 by 6,000. Now let's talk about standard costs. A standard is a price, cost, or quantity that's expected under normal conditions. So you can think of some of the standards as like a budget per unit. When you look at a standard cost of a product, that is like a budget for 1 unit of product. And a standard cost system is an accounting system that uses standard costs. Now, companies establish price standards for materials and labor. The materials include not only the cost that they have to pay for them, but also takes into account any discounts they might get, freight in and receiving costs. And direct labor includes their basic pay, so the hourly amount that they pay their employees, plus, of course, payroll taxes and fringe benefits. So all of those are built into the standard prices. Then there are standard quantities. So direct materials, we ask the question, well, how much direct materials should be used if employees are working efficiently? So that's going to be some quantity for each unit of product. Direct labor, how many direct labor hours should be used for each unit of product? So be careful with the different types of units because there are finished goods units, there are direct materials units, and there are direct labor hours, and those are all different units. So for example, you might have a unit of finished product, like let's say we are making watering cans. And so you have plastic watering cans. That's your finished product. But each can might use a half a pound of plastic. So be careful because the half a pound of plastic is in pounds and the finished goods are in units. All right, so let's take a look at the variances that we calculate for materials and labor. So remember the static budget is here. Our sales volume variance is here, and our flexible budget variance is here. So the flexible budget variance is broken into 2 different variances called a cost variance and an efficiency variance. The cost variance shows how much did you pay per unit of direct materials compared to how much you should, or how much did you pay per hour of direct labor compared to what you should. And the efficiency variance talks about the quantities that you used. It's sometimes called the quantity variance. So what quantity of raw materials did you use, or what quantity of direct labor hours did you use compared to what you should have used? All right, so let's take a look at this. This is how you figure out your variances. And let's look at the cost variance. So remember what I said, the cost variance shows us how much did we pay for either per hour of labor or per unit of materials compared to what we should have paid. And so the actual quantity stays the same here. And so we're looking at the difference between the actual cost and the standard cost. When you multiply these through, you compare them to get the cost variance. And of course, if the actual cost is greater than the standard cost, you're going to have an unfavorable variance, and vice versa. Now the efficiency variance, remember I said, is like the quantity variance, and that looks at how much of each thing we used. How much materials did we use? How many direct labor hours did we use? So in this case, the cost is held constant, but we're looking at the difference between actual quantity and standard quantity. Now the standard quantity is the tricky thing here, let me tell you. The standard quantity is the thing that you need to keep an eye on when you do this. So the standard quantity is the quantity allowed for actual production. And so what that's equal to is your standard quantity per unit times the actual units produced. So standard quantity allowed for actual production, standard quantity per unit times actual units produced. And when you're all done, you take your cost variance and efficiency variance, you either add them if they're the same, too unfavorable or too favorable, or you net them if they are opposite. So if you had a $10 unfavorable and a $20 favorable, net them together and you get a $10 favorable. All right, that's all we have. I think you should be ready to work on your chapter materials now. See you in the next video.